Hello, chart watchers, and welcome to this Tuesday, May 1st Market Watchers Live show with your hosts, Tom Bowley and Aaron Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, May has begun, and it's not off to a great start. You can see the Dow Jones Industrial Average currently down more than 300 points. The S&P 500 down 18. The NASDAQ doing much better on a relative basis, but also down 17 points. The Russell 2000 off of its low, but still down nearly 9 points. The 10-year Treasury yield is bouncing. It is back up 3 basis points to 2.97%. Volatility index, as you might expect with the selling, has rebounded up 4.6% to about 16.70. Technology on a relative basis performing pretty well, though. You can see flat today despite the big losses. Industrials not faring quite so well, though, breaking down below those earlier lows that we saw to open April. Pfizer and Merck both reported earnings and really putting pressure on the pharmaceuticals, both down, as you can see, rather significantly after earnings reports. Intel, the best performer in the Dow, up 1.63%. And Qorvo, another semiconductor, is the best performing S&P 500 company. And with that, let me turn it back over to my co-host, Aaron. How are you doing this morning, Aaron?
I am doing quite well. Kind of a gray, damp looking day. We're supposed to get a little bit of a thunderstorm. This is Southern California. I have no idea how to deal with that.
Never rains in Southern California.
No, and if it does, we generally don't see a thunderstorm. It'll bring back my days in living in Ohio when I was in the Air Force.
Well, thank you for your service.
Oh, thank you.
Yeah. We got some pretty good weather here in the southeast. It's been nice. Supposed to be nice the rest of the week. It's warming up. We're supposed to actually get close to 90 by the end of the week, which is what I was kind of fearful of. We didn't really have spring. We had sprinter. That's what I'm calling it. We had just a little bit of spring sprinkled in with winter. But that seems to now be moving straight into summer. But hopefully it'll cool back off and we can enjoy some spring weather.
Oh, I know. It'll be a little tough on that golf course, huh? In the 90-degree weather.
Yeah, it doesn't bother me on the golf course.
Okay.
40-degree weather bothers me, not the 90. I'm fine with the 90.
All right. Sounds good.
Yeah, we got a lot going over. I know you got your DecisionPoint, a lengthy DecisionPoint report, a special monthly report coming up. So let's go through the announcements in the agenda and get started.
Absolutely. So as far as this week is concerned, tomorrow we have Tom McClellan will be here as our guest. And I know lots of you have requested him to come back. The last time he was on the show, he was talking about an April-May decline or correction. And so he seemed to be right on with that. Bruce Frazier will be here with us Wednesday, Mr. Wyckoff. And then on Friday, we will do the Everything Stock Charts segment. And we'll have somebody from the Seattle mothership to come in and tell us about something new on the website. For today's agenda, though, I will be doing the DecisionPoint monthly chart review here. I will go over all those monthly charts, and I have lots of information to share. 10 and 10 to 1 after that. First symbol will be Federal Signal Corp, FSS. And finally, we're going to finish off with Under the Radar. And with that, I'm going to pass it back to you for some technical news and headlines, and I'm going to get myself together for the monthly review.
Sounds good. Well, we got a bunch of economic news out, and actually the rest of the week is just absolutely loaded. We've got Apple reporting later today after the bell. That's going to kind of get things kicked off. But you can see currently, well, let me get an update, make sure we got current. But it looks to me like we got 2.97. Yeah, it's still rising, 2.974 right now percent on the 10-year Treasury yield. That comes on the heels of the April PMI manufacturing index that came out earlier today as expected at 56.5. April ISM manufacturing index actually was a little lower than expected, 57.3 versus 58.6. And then March construction spending dropped 1.7%, market anticipating a rise of 0.5%. So a really big miss on construction spending. But of course, that is somewhat of a lagging report back in March. Fed meeting starts today or started today, earlier today. And the latest FOMC announcement due out at 2 p.m. tomorrow. So we'll see where the Fed sits on everything. But mentioned, we've got Fed meeting. We got Apple coming out after the bell. Tomorrow morning at 8:15, the ADP employment report comes out. Then we've got jobless claims that typically come out on Thursday mornings, productivity, factory orders, all of that's Thursday. And then, of course, on Friday, the non-farm payrolls report. So there is a ton going on. Apple reports after the bell. And one of the things interesting about Apple is it's kind of, along with many of the other technology stocks, performing pretty well today. This is one area of the market that is essentially ignoring a lot of the selling that's taking place. The Dow Jones getting hit pretty hard, but Apple has performed well. And I've got a chart list that has all the Dow components in it. So I thought what I would do first is just kind of show you this summary. And so if we pull it up in summary form, you can quickly see that Pfizer is losing the most. Merck is second. Then we've got McDonald's, Caterpillar, and United Technologies. And if you hit this, it flips it. And now you can see Intel, Apple, and Microsoft, three of the big technology companies, the only three Dow stocks that are in the green today. And you go down a little bit further, you see Cisco's not having a bad day. And a little bit further, IBM. So you got the five technology stocks. There are five technology stocks in the Dow, and all five of them are in the top 7 of the Dow Jones. So technology seems to be avoiding everything today. And I think if we look at the S&P 500, we'll see some similar action with the summary. But Intel was doing well. Corvo, here's Corvo. This is one I mentioned at the top of the show, up 7% today. Part of it, though, with Corvo, I think, is a positive divergence. I think we're getting a nice little bounce after you can see lower prices here with a higher PPO. And now we're going right through that 20. I think we're going to have some issues up around 74, 75 if we get there on Corvo. But at least for now, nice move to the upside in that semiconductor space. And when you look at this, you see there's a semiconductor come down here, Skyworks, another semiconductor. And of course, we talked about Intel, semiconductor. And then you've got Lam Research. So several of the stocks that are doing well in the S&P 500 are in that semiconductor space. And that bodes well for technology for sure. Let's take a look at the dollar. Another big move today higher in the dollar. And you can see another huge gap up. It's up about 3/5 of 1%, up 0.60%. And this has just been a huge rally here over the past 2 weeks to the upside. And as you might expect, rising dollar, that's a problem for gold. Gold is threatening a breakout, or excuse me, a breakdown to the lowest level we have seen in 2018. It looks like on an intraday basis we got there. We have not had a close below 124 this year on the GLD, and right now we are trading at 123.87. So that is worth keeping an eye on. Let's see. With the dollar up, we typically see the Russell 2000 outperforming. Now, recently we haven't. I wanted to bring up a chart to kind of highlight what's going on here. So let's pull up the Russell 2000 relative to the S&P 500. I'm going to leave it as a daily chart. I don't like using candlesticks with these relative charts. So let's use a thick, actually, I don't want a dash line. Let's use the solid line. And down below here, I want to show the dollar. Don't care about the RSI. So let's put in the dollar. We'll just put the UUP in there. And then I'm going to put that behind the price action, behind that ratio. And I want you to just kind of take a look at what's going on here. All right, so over the last several months, you can see the pink line is the dollar. And we had a pretty big move down in the relative ratio, Russell 2000 versus the S&P, and the dollar followed it to the downside. Then we had a huge spike earlier in the Russell 2000 versus the S&P 500, and now here comes the dollar to follow to the upside. Now, I don't think this move in the dollar is over. We could certainly consolidate. We've been going straight up for a couple of weeks here, as you can see, with hardly a pause. So maybe we consolidate, but I think this is the start of a much longer term move to the upside in the dollar. As I've been mentioning, and I can pull it up one more time for those maybe who haven't been around. But when we see the dollar starting to play catch up with the treasury yields, and I'm looking at U.S. versus Germany, that just broke out to a new relative high. And as this goes higher, generally the dollar follows suit, except we have had these periods of an inverse relationship. And each of the previous 2 times we've had these inverse relationships, the red shaded area that you see on these charts, it has been followed up by a huge move up in the dollar to play catch up. And so I think this is a start of something that could be very substantial. I think it's also important to note that the dollar, when it came back down to price support and trend line support. So technically, it seems like this is an area where we would expect to see the dollar bounce, and interest rates are certainly agreeing with that. And the correlation between the two, which tend to be in positive territory, are just turning now out of this inverse relationship. And you can see what's happened the last couple of times we've seen that. It quickly catches up and moves back well into the positive correlation area. So I think the dollar is just beginning to play catch up with what we've been seeing with Treasury yields. And I think that does not bode well for gold. Now, some of you might say, well, what about energy? Because energy can be impacted by a rising dollar. To me, energy is not impacted to the same extent that gold is. Gold is, and the dollar over long periods of time have a very significant inverse correlation, meaning they move opposite one another. It's not quite the same with the dollar and crude oil. So I'm going to show you. Let's take a look at crude oil prices. Try and illustrate this for you. Let's go back a few years here. Let's go back 3 years, and let's pull up the correlation. And we can pull up the USD. And that should do it. Let's see if that works. I'm gonna make this chart just a little bit bigger. Let's go. All right, so this is crude oil on the top, and then this is crude oil versus the dollar. This is the correlation. Now, when you look over the last 3 years, I'm not sure you can really tell. I mean, is it an inverse correlation or is it a positive correlation? We spend just about as much time above the zero line as we do below the zero line. So I'm not really seeing a negative correlation. I know that the dollar does provide headwinds for crude oil, but you also have to be thinking about demand. As global economic conditions strengthen, the demand for crude oil rises. And as global economic conditions move higher, I think that also bodes well for the dollar, especially if the 10-year Treasury yield versus Germany that I was just showing you, if that continues to rise, that should bode well for the dollar. Crude oil and the dollar, in my opinion, can go up together. So that I think this correlation kind of demonstrates that. I think if we look longer term, there might be a little bit more of a negative correlation, but you can see that there's not a direct inverse correlation here. Now let's pull up gold and take a look at over the same last 3 years, how gold has fared versus the dollar. And here, I think you can see the majority of the time is spent in negative territory. We have a couple of spikes. You know, maybe we get up above positive 0.50 a couple of times, but it quickly goes right back down into negative territory, and that's where it resides most of the time. And again, let's go back to the crude oil and take a look. Completely different scenario in my view. So dollar rising doesn't necessarily be, it's not necessarily going to be a huge negative impact on energy. Energy, the problem with energy right now, and it is down today, is ExxonMobil. We've talked about this plenty, but there are 3 stocks that make up almost 50% of the performance of the XLE. The biggest one is ExxonMobil. I think it's like 23% of the XLE. And ExxonMobil down again today. It failed to hold that rising 20-day moving average, and technically it's struggling. If you look at the other major components, I think Chevron is like 16 or 17% of the XLE. This one's continuing to trade well above its 20-day moving average, and I think performing quite well, getting fairly close to that January high that we saw. And again, if we go back and look at ExxonMobil, we're nowhere near that January high. So on a relative basis, Exxon is really keeping a lid on the XLE right now. The other stock that is about a 7 or 8% component of the XLE is Schlumberger, and Schlumberger is kind of between the two. ExxonMobil really weakening, CVX remains strong, and Schlumberger is still holding its 20-day moving average, trying to put in a hammer here on the 20-day. So I'm still okay with this one. But, if we go back down close toward the low of the day, Schlumberger is going to start rolling over. So in my opinion, that's what's putting pressure on the XLE. It's not the rising dollar. Crude oil prices continue to be pretty strong. And if we just look at the absolute chart on crude oil, I think you'll see we made a breakout above the 66 level. If anything, had maybe a little bit of a cup off an uptrend, pull back into a handle and break out. And we've been holding 66. So I think as long as crude oil holds $66, this remains in an uptrend along with the dollar. Another way to look at this is looking at the CRB index, which is an index of commodities. And I believe last time I looked, I think 42% of it was related to oil, energy. But this just got a breakout, and we're not too far from the high. So the commodity index is performing pretty well. The big problem is simply in gold. And when we look at the gold chart, the GLD, again, you can see this 124 level is pretty big. GDX, which is the gold miners, has been declining here over the last 2 weeks while the dollar's been moving higher. And the same thing with the junior miners, GDXJ. Again, these last 2 weeks have been very weak. And the big problem with gold is when we look at the long-term picture and compare it to the S&P 500. This is why I have no interest in gold. Been talking about it. I know, technically, if we could get a breakout and it started leading the S&P 500 on a relative basis, then I would feel a little bit better about it. But if we pull up a weekly chart, again, I'm going to switch out of the candlesticks and let's go back. Let's just go back the last 10 years. Here is the relative performance of gold versus the S&P 500. It topped in 2011, and it has been trending lower and lower. We get brief periods of outperformance, but I think looking at this chart, it's really hard to make an argument to be long gold. The GDX, I think if we pull up the same chart relative to the S&P 500, I don't need the dollar sign there. So there you've got GDX. Again, we had maybe 6 to 9 months of relative strength here. But other than that, this is an area you just don't want to be in. Pull up the GDXJ, junior miners versus the S&P 500. And I think you're going to kind of get the same picture. Again, we had a 9-month period here. We did pretty well. Other than that, since 2011, this has just been an area that is very difficult to make money in. Certainly difficult to make money in relative to the S&P 500. I mean, most of the time, I think you'd be better off just parking your money in the S&P. Now, at some point, this will change, and when it does, then you can ride the relative strength. But as long as the dollar is strong and this longer-term downtrend remains in play, I think gold, the gold miners, the junior gold miners, and so forth are not the place to be. Let's take a look at the German DAX, and I'll tell you why in just a minute. But German DAX, last time I looked, was up today. I want to say it was up about 30 points. And this is a pretty big area on the DAX. After the huge drop in early February, the reaction high, we've struggled to get a close above 12,600. Last time I looked earlier today, it was at 12,631. I'm not sure where it is right now, but that would represent a breakout. Why is that important? Well, if we take a look at the DAX, and again, I'm going to go back to correlation and compare this to the S&P 500, and we can go back a ways. Let's go back weekly, and we'll go, let's go 10 years. That's throughout the bull market. And you look at the correlation. Look at this correlation. Pretty strong positive correlation between the German DAX and the S&P 500. And here's a long-term chart on the DAX, which I think the uptrend remains intact, even though we had pretty significant weakness earlier this year. We went down, tested these lows. I think we're starting to turn back up, and a breakout above that 12,600 level. Actually, 1,200. I think it was 12,631 is where it was earlier. But anyway, if we get that breakout and the 20-week EMA is at 12,534, so we have broken back above that, and we've got the 50-week at 12,653 looming. But if we go back through both of those moving averages, I think it's important to note that the correlation between Germany and the S&P is pretty strong. So with that, I would be at least considering that as a bullish sign for the S&P. Now, in contrast, I want to show you China, the Shanghai. You get a lot of news stories that come out and say, well, And I've seen this many times before about what's going on in China and how that's going to impact us in the U.S. Well, when I look at the long-term correlation with Shanghai and the S&P, I don't see the same picture that I see with Germany. Germany is a very tight positive correlation. I would say that we do have some positive correlation here, but it's not nearly as strong as what goes on in Germany. So just wanted to point that out. We do have some pretty strong correlation right now going on with China. And with that, I think that's enough for now. I'm going to turn it back over to Erin. I know she's got a lot of decision point updates for you, and I know everyone's looking forward to that. So take it away, Erin.
All righty. I'm going to try not to fire hose everybody because there is a lot of information that I'd like to go over today. So what I want to do is we're going to look at the charts that went final yesterday. So when DecisionPoint does their reviews and their signals, some people will notice that on our scoreboards, the date may not line up as far as the weekly and the monthly signals with the actual exact day that it switched. And that's because we have to wait until the end of the week, the last trading day of the week, for our weekly signals to go final. And we have to wait till the last trading day of the month before all of our monthly signals go final. So that's why I figured it would be a great idea to go through the monthly charts that went final and see what we're looking at. I did write an article about this. Go over there. Just yesterday in the DecisionPoint blog. So if you've read that, you got a quick sneak peek as to what I'm going to be covering today, but obviously I'll be able to speak more to each of the charts. So what I plan on doing is we're going to look at the monthly, weekly, and daily charts for the large cap indexes, and these are the scoreboard indexes that we cover for DecisionPoint. Then we're going to look at the mid and small cap indexes. I like to use the ETFs, IJH, IJR, and IWM. So those are the charts we'll look at for those. And then I'm going to cover what DecisionPoint calls the big four: dollar, gold, oil, and bonds. So we'll look at all of those charts as well. And then finally, I'm going to end it on what our DecisionPoint indicators are saying right now. I think actually those charts are looking very, very interesting. So I think it's important to finish with the DecisionPoint indicators because I think of all the takeaways, I really do want to have those DecisionPoint indicator charts be your main takeaway from this chart review. And with that, let's go ahead and get started. The DecisionPoint, and I'm going to go take us here. If you go to the blogs page, and if you choose the DecisionPoint blog, you'll see this link to the live chart list for DecisionPoint. All of these charts that I'm getting ready to show you for the monthly, weekly, and daily are all in this chart list. So you can actually go in, see my annotations. I try to keep them up to date, but with monthly charts, obviously, I generally don't update those until the final day of the month. And the same with the weekly charts. But you can find all of the charts I'm getting ready to go over in the DecisionPoint Live chart list. And of course, anytime you guys see a chart that you would like for your own, if you click on it, it'll bring it right up in your workbench. And at that point, if you click annotate and annotate it even just a little bit, it'll ask you if you want to save it, and you can say yes. And then all of a sudden it's in whatever chart list you wanted. You'll now have that chart with the annotations, and you can see how that chart was set up. So I know a lot of people ask about Tom's relative chart, and you can get a copy of that really anytime you see it on the website. If you click on it, you should be able to get to it. And these style buttons will help you set those up so you can get to them quite quickly. Because Tom, I actually did set up one for your relative chart as well. Obviously, the SPY doesn't have relative information on it, but I do have that. So let's go ahead. Here are those charts in that DecisionPoint Live chart list. And I'm going to just start right here at the top. I'm going to start with the monthly charts and work back, because typically when you do your analysis, that's really what you want to do, especially if you're going through, your weekly and monthly charts, like I do at the end of the week for your weekly or the end of the month for your monthly. It's better to get that big picture. so that you have a feel for what are the market trends, what is the big picture looking like? Where are we possibly in a setup for a bear market, or are we in a correction, that sort of thing? This is where you want to go. Start with the big picture and then work your way down. And I suggest you do that with a lot of the, especially your investments. It's always a good idea before you jump into anything to look at the monthly, weekly, and daily. So let's go ahead. We're going to start with the Dow Industrials. And just a reminder, I do have a poll running right now in the chat room. And if you want to go and take that poll, that would be great. But I'm basically asking whether you think the market is going to close higher or lower in the month of May. So by the end of the month, do you think it'll close lower, higher, or mostly unchanged? So go ahead and take that poll, and we'll take a look at that at the end of this segment. Here we are. All right, so one of the things I want to point out is that when we're looking at the monthly charts for the large cap indexes, all of them have these bearish rising wedges drawn from about the 2009 low to not the high for 2009, but the next minor highs. So I've filled those in, and that is, obviously you don't want to see those, but I've seen a lot of wedges on monthly charts not actually execute as you would expect. What I think is most important when you look at these monthly charts is to note the margin between price and the rising bottoms trend line, because we have room to correct further, and in my estimation, not really make it into a bear market if we stay above that rising bottoms trend line. I suspect if we go down close to test it, we probably are in the midst of a bear market or the beginning of such. I'll be watching these EMAs. We use a 6-month and a 10-month EMA. And on the weekly charts, I'll show you we use a 17 and a 43-week EMA. And both of these we've selected mainly because they tend to have their crossovers at about the same time as the 50 and 200-day EMAs on a daily chart. So here we go with the Dow's monthly, and I'm going to look at the weekly chart at this point. So I do have a rising bottoms line drawn here from the mid 2017 low right at right where you can see it here. And you can see we have been penetrating that rising bottoms trend line. And I said on the monthly chart, if we penetrate that line, we're in a bear market. In this case, I'm not quite so concerned, only because we're seeing the 43-week EMA holding up as support. We came down, we broke down below it, and in fact, over here, about the end of March, mid-March, we actually closed right on top of that and below this rising bottoms trend line. Right now, we're looking at a close that would be below that trend line, but we've managed to get back up on all of these cases above that rising bottoms trend line. So we'll need to watch that very closely. At this point, the most important feature would be that 43-week EMA and looking for that support level. Clearly, we've been on these sell signals on the weekly charts, and we have to keep that in mind. Clearly, the PMO has no interest at this point on that weekly chart for turning up. It's not even decelerating at this point. And again, I think these are the kind of signs that we haven't seen in a very long time. And these signs are what are bothering me going into May. Let's make a quick peek here at the daily chart for the Dow. And what I've noticed is this descending triangle, which is a bearish pattern. We managed to break above that declining tops trend line, and I thought we might be coming out of this. We had the 5-20-day EMA positive crossover back here, broke up above, and now we're coming right back in. And if you annotate this, you could adjust this declining tops trend line if you would like to there, or bring it down right there so you hit a little bit more of these tops. In any case, it still is a descending triangle, and that is bearish. Notice today We did not have this yesterday, but we're starting to see PMO sell signals appear on the daily charts. And I will be changing the scoreboard if this holds up into the end of the day. I suspect if we continue with a 1% drop or even a 0.5% drop, we will see those PMO sell signals. So let's move on to the NASDAQ. Oh, I want to start with the monthly. All right. Again, bearish rising wedge, but there is margin between price and that rising bottoms trend line. We are seeing the PMO topping, and this didn't just happen. This happened, I believe we got the first turn down at the end of February. Not a surprise given the correction that we experienced in February. But these are the things that I will be watching closely on the monthly charts. Again, bearish patterns topping PMOs. The weekly chart for the NASDAQ 100, holding on to that rising bottoms trend line, looking similar to the Dow, only it hasn't gone down below, and it still is that the 43-week EMA is still holding up as support. But we have that PMO sell signal, and again, we are not seeing any deceleration in the negative momentum going on here. As far as the daily chart, we do not have a sell signal lining up just yet on the NASDAQ 100. We still have a little bit of margin there before we'll get that signal. At this point, what I've been looking at on the NASDAQ is a possible head and shoulders. The neckline would be rising. I suspect if I want to go from the lowest close back here, you could use the 6,300 level as the execution area for the head and shoulders pattern. I'm just choosing, because I do use OHLC bars all the time, I am choosing to use that intraday low on that particular day. So at this point, I think we have somewhat of a complex head and shoulders setting up here. And we still have some margin, we still have some travel space to move lower on the NASDAQ without actually executing this pattern. The OEX monthly chart, another rising wedge, PMO that is topping. Notice the margin here in the thumbnail. We've got, it's much thinner than we saw on the previous charts. So again, we're not losing any of this negative momentum either. It's still continuing. I would expect to see either by the end of May, if not by the end of May, the end of June, that sell signal. And that's, of course, if we continue in this corrective, possible bear market mode here. Weekly chart for the OEX. Again, these rising bottom trend lines are what I'm really paying the closest attention to. And you can see the OEX on the weekly chart is beginning to test that. We have an intermediate term PMO sell signal. And again, no deceleration of these PMOs, and that is worrisome. OEX daily chart. 200-day EMA right now seems to be holding up as support. We've just about got this PMO sell signal lining up. And again, I just don't like the setup on pretty much all of the index charts right now. I think the only good thing I could say right now about the OEX is that fact that the 200-day EMA so far is holding up as support. Although we can see it hasn't in the past. I suspect we're going to see another test down here at about 1120 on a decline. Okay, the S&P, the one everybody's been waiting for, I'm sure. Again, rising wedge, another one that is getting ready for a monthly PMO sell signal. One thing that you should note on this chart is that we don't get a lot of crossover signals here on a monthly PMO. We don't. I mean, how many have we had just on this one chart? We got a little whipsaw back here, but if you don't count that, 1, 2, 3, 4, 5, 6, and we're getting ready for a possible 7th, and that is in a 20-year time frame. So these are the kind of signals to pay attention to. And seeing this lining up, seeing it come in with a lower top, getting declining tops on this PMO. We know how these negative divergences generally play out. And you can see the rising tops on price, that's a pretty serious negative divergence. And again, typically when you see those types of divergences, they don't end well. So I am still looking for, again, a test here of this rising bottoms trend line, but I am feeling more and more bearish about the market as we go. And it's not simply because I had the weekend with Carl, who has been brave enough, I will say, from the very beginning to take a stand and be one of the first to say, no, we've entered a bear market. So something to be said for that. I am still straddling that line, but the more I look at these charts, the more I see these divergences we haven't seen in a while, the more bearish I become. So as we can see with the large caps, the S&P 500, the weekly chart, again, rising bottoms trend line is very important. We're getting ready now to test that 2,600 level of support. And, you know, the way it's set up, and again, look at this very negative PMO. The way it's set up, it really does look like we're setting ourselves up for a breakdown below that rising bottoms trend line. As far as the daily chart, we don't see that PMO sell signal just yet, like we saw on the Dow that is set up for today. Again, keep an eye out for a DP bulletin this afternoon and tonight if we do get that PMO sell signal on the Dow's chart. So as you can see with the S&P 500, 200-day EMA rising bottoms line support is still available for price. You know, but we've got to, again, PMO sell signal. Number one, just anytime I see the PMO top below the zero line, that gives me pause. That's an attention flag to me that there's some serious issues. And then if you get the sell signal below the zero line, I think that is also very, very negative. Notice, again, in the past year, we've really not spent a whole lot of time below the zero line. And if I bring this out, let's try 5 years. You can see really the last time that we spent any time below the zero line was back here at the beginning of 2016 during that correction that we saw. So not a surprise to see this given the condition of the market going on right now. But certainly something to think about whenever you see oscillations below the zero line, really in any of the oscillators out there, that suggests internal weakness. When you see the oscillation above the zero line, and this is a great example right here, that typically means that there is internal strength. And looking at this very strong rally, that is definitely the case. All right, actually, I'm going to show you this other long-term monthly chart. This was just sort of a fun little thing I did. I have no idea whether this is useful or not to anybody, but I look at these really long-term charts and I do want to know, what does a bear market honestly look like? Where are we going and where does, how does this all line up in the historical way? And, we had these big travel moves is what I call like travel time. And then you stay in a range where you do have bull markets, bear markets, bull market, bear market. But then we had that very unusual time in the 80s and into the 90s with the dot-coms. And it basically elevated our normal range. And so here we had your bull market, bear market, bull market, bear market. And then we started to travel way outside that range. We got the little bit of that pullback, on that corrective move back in 2015, 2016, right in there. But we never really saw what I would call a bear market move. And my thought is that we're now in a new normal range. Now, this could be travel time to somewhere else, but the fact we topped back there and are continuing down, this could be our new normal, in which case, if we do enter a bear market, it could certainly get ugly, but that's what bear markets are. They are ugly. All right, let's look at the mid caps, the S&P 400. And in a lot of these cases, I'm not necessarily seeing the rising wedges. In this case, we do have a rising trend channel, which is positive. However, we can see that rising bottoms trend line, the bottom of this channel is being tested right now. But this is the feature to pay the most attention to. That PMO sell signal on the mid caps is lined up, and we should be seeing this one come in at the end of next month. Again, we can't call these signals final until the last trading day of the month. And this particular negative crossover is occurring on May 1st. So we'll have to see if it can stick around until the end of the month. Again, another negative divergence with PMO tops. And again, when I see those negative divergences, they generally don't end well. The weekly chart for the S&P 400, we're looking at, again, this rising trend channel, but we are on that sell signal. We are not seeing any deceleration of the PMO on its way down. There's a good chance we're going to end up with a lower low on the PMO as well. While this trend channel is holding up, as you've seen in really most of the other monthly, weekly charts that I've shown you, they're really hanging by a thread somewhat. They're sitting on what could end up being very strong support in these rising bottoms trend lines, but I don't think it's likely they're going to hold up. Look at IJH, just got a PMO sell signal. I'm pretty sure that one came in yesterday when I was looking at charts. Rising bottom trend line on its way to be tested, or if you want to follow moving average support, you can see the 200-day EMA is pretty much right there on top of the rising bottoms trend line. So in either case, that's the area of support we're going to be looking at. Right around, looks like a 183.50, somewhere in there. But when I see, again, that PMO sell signal, in this case, with the price tops and the PMO tops, they're in line with each other. And that means we have a bearish confirmation. So the PMO tops and the price tops are confirming each other, the fact that they're both in decline. All right, small caps, IJR, S&P 600, rising wedge in this case. You can see that the rising bottoms on that wedge is just about ready to be tested. And we have a PMO topping back here, and we're getting ready for a sell signal. Now, I've pointed this out because we did get a bit of a fake out here. We didn't get that sell signal, but it's looking pretty good this time around. But if we can hold that rising bottoms trend line support, we should be okay on the monthly chart for the S&P 600. IJR. This is the daily chart for the small caps. Actually, I want to move over. We're going to start monthly and work our way back again. All right, another rising wedge, PMO topping. I think I did just look at that. Weekly chart. We are on that PMO sell signal, rising bottoms trend line support. I think you're seeing a theme here, which is why I'm not going to go too deeply in it. Rising bottoms support and PMO topping or sell signals. That's pretty much what we're looking at right now. We have a PMO sell signal. It says nearing. I haven't had a chance to change the annotation, but you can see that we had that PMO sell signal. It's now, we got that drop below that very short-term support at about 78. And we're looking on our way down to 75 and that 200-day EMA. Again, not looking so good for small caps here in IWM, Russell 2000. And I know this is a little bit not in line with seasonality, because I know Tom's been talking a lot about that. And I think that's something that we should be aware of as well. Right now, I see a rising wedge, again, topping PMO. We've got a pretty decent sized margin here for the PMO before we get a crossover sell signal. But again, notice we don't get signals very often. So we do have to pay very close attention. Russell 2000, and here we go. Very similar again, sell signals and daily chart for Russell 2000. Again, a breakdown. I'm looking for support all the way down here at 148. Notice we're getting a PMO sell signal today. So this is pretty timely that I'm doing this particular report today, because we are seeing, even in the very short term, PMO sell signals starting to present themselves. All right. I'm going to look at the dollar, gold, etc. Right now, and then we'll look very quickly at those indicators. Bullish declining wedge. I think the dollar just looks fantastic right now. It needs to get above this 92.50 area, but I think with the breakout, and I'll show you on the daily chart today, it looks fantastic. PMO is above zero. It is decelerating slightly. I think this is the place we're going to see that bottom. We're going to see some internal strength here off of the dollar. Weekly chart. We already are in a buy signal on the weekly chart. Look at that breakout from the intermediate term declining wedge. Very nice setup. I suspect we're going to see quite a move in the dollar. Look at the breakout. I waited so patiently, and boy, did I get that breakout. We had the PMO buy signal come in. We had that great breakout. I'm looking for 2470 to be the next area of overhead resistance for the dollar. Gold monthly. You know, I like the look of the gold monthly chart. We're looking at an ascending triangle, but we also know that 1400, 1380 level has been extremely difficult for gold to get through. And notice on the weekly chart, we just got a PMO sell signal. So definitely problems going on for gold. And one thing to note when you look at the correlation is there is a high inverse correlation with the dollar right now, very high. And dollar is looking fantastic. So what does that mean for gold? Likely is going to suffer. USO, buy signal on its way now into positive territory. Again, had the breakout above that $55 area for WTIC. Looks like we're heading up to overhead resistance at about 75. That could pose a bit of a problem, but you know, oil has been doing quite well. It's looking like the dollar. I don't suspect, Tom, you said it earlier, I don't suspect that a rising dollar is going to hurt USO at this point in oil. Weekly chart, as you can see, getting a little into the overbought area, but really when you look at the negative end of the PMO around 15, I wouldn't call this overbought. I think we're doing okay. And the daily chart very quickly for USO and WTIC. We're now starting to consolidate a bit here sideways, but the good news is we're doing that consolidation on support. Right at these highs that we had back in January and March. So I think we're doing okay right now. And it did break out from that ascending triangle. Bonds are ugly. I can just say that right off the bat, looking at a head and shoulders pattern, a very large one. I am actually looking for a drop to about 120. And notice this, we have not seen the monthly PMO on bonds get below zero in quite some time. The last time it was traveling below zero was back in the 80s. So I suspect we're going to see bad news, much more decline on TLT and bonds. And there you can see that stretched out head and shoulders. It's a little bit clearer, rising neckline, getting ready to be finished off. Daily chart. Here we go. Rising bottoms on the PMO, which is, you know, interesting off of this big rally. But notice it's already turning down. I suspect we're going to see, again, long way down for TLT. All right, running out of time here, but we're going to wrap this up. What I wanted to mention about our climactic indicators, and again, I use these in the very, very short term. This is like day trader term. We're talking about the next day, hours to days. And what I wanted to note was yesterday we had some climactic readings to the downside. I'm not getting the coordinating puncture of the upper or lower Bollinger Band on the VIX, but seeing that spike off of this first day's decline, I'm looking at this as a selling initiation. Short-term indicators, I've written plenty about this, so you can go check it out in the DecisionPoint blog. The main thing I want to point out is, of course, that negative divergence. I've not seen these in a very long time. And, you know, when you see these divergences, this is the volume indicator. And so when you see these tops moving down, this is telling us price is rising, but we're not getting the confirming volume behind it. And note right now we've got tops below the zero line. And finally, intermediate term indicators. We're seeing a new negative divergence on the ITVM, and on the ITBM, we're about to hit that. I don't think these indicators look good either. So just to give you a really quick recap here for the monthly charts, I looked at those, and remember, long-term PMOs have topped. That margin is the margin is thinner, but there's still room. Bearish wedges, mid caps. I'm going to put all of this in the Market Watchers Live recap. Long-term PMO is falling and on the mid caps and small caps, and that is a very thin margin. We could see some of those sell signals coming in. Testing rising bottoms trend lines now. Remember, we had a little bit more room to decline on those large caps, but the mid caps and small caps, they need to figure it out right now because they're sitting right on that rising bottoms trend line. Big four, dollar, we've got that bull wedge. It's ready to execute. Support is holding. I think the dollar looks fantastic. Gold has a high inverse correlation right now with the dollar, so I expect if the dollar is doing very well, we are not going to see gold do well. Oil, the breakout's continuing, and bonds are highly bearish, head and shoulders. Finally, as far as our indicators, the stock market condition, trend model signals, we're on sell signals in the short term, neutral in the intermediate term. We are still on buy signals in the long term, but we're seeing the 50 days getting really close to 200-day negative crossovers. Stock market condition, we've got the climactic indicators that suggest a selling initiation over the next day or two. Short-term indicators are bearish. Intermediate-term indicators are looking bearish as well. We got that negative crossover on the volume component of the ITVM combo, and don't want to see that, especially below the zero line. With that, that concludes it. I know that took up a lot of time, but I hope I gave you a pretty good feel for what's going on in the stock market and what we should expect in May and what pretty much happened in April. And with that, I am going to invite you back, Tom, to do the 10 and 10. I was able to put in some. I'm just going to read them off, though, because I know we're getting a little bit crunched on time.
Okay, yeah, I'm ready. That was a very good presentation, by the way. I mean, definitely, if you're a moving average following person, there's no doubt that the consolidation that we've seen for these last 2 or 3 months is having quite an impact on many of those moving averages. And it's interesting to see some of those longer term moving averages moving down and generating some sell signals that we haven't seen for quite some time.
Absolutely.
All right, what do we got?
Okay, let's see. We'll be starting off with FSS, the Federal Signal Corp. So go right to that, and I'll be getting these others in.
All right, start with FSS. By the way, this was Best Buy from yesterday. I know as it was getting up near that resistance, it looked pretty good. But take a look at Best Buy coming back down after hitting that resistance level. I think that was a pretty good lesson in just seeing overhead resistance and just being aware of it. FSS, I don't like the action today unless we get a reversal. I think this is a pretty key area around 2150. So if we leave a long tail below and come back up and hold it, then I would be a little bit more bullish. But otherwise, I would be real careful with the stock. We are breaking down. I would maybe even off of this huge volume candle here at the latter part of February, you can see the reaction low after getting up over 22 was around 21. So maybe I give it just this range right here, but we're now below both moving averages. We got a bearish crossover of that PPO center line. Volume is beginning to pick up. So let's get a reversal today, hold this 21 level, or else I would be real careful with FSS.
All righty, let's see what is our most popular in the chat room as far as likes. And Square is the winner. So SQ.
Yeah, I think Square. I think someone was saying that a big short had come out and said something about the company and the fact they thought it was only worth $30. Stock was doing really well trying to break above its 20-day moving average when that story came out. And then, of course, the stock fell back about $3. It's trading under its 20-day moving average. And you can see the volume trends of late have not been particularly good. So I really want to respect what's going on with the 20-day moving average. But that is the volume that I was talking about. Big days, you can see these big red candles on heavy volume and these little squishy little candles coming back up on much lighter volume. and so far failing at the 20-day moving average. So I think that there are some warning signs here in the short term. Overall, longer term chart, I think Square looks really good. I would just be careful. I don't like it when you come up, fail at the 20 and start to roll back over again. So watch that 20-day and let's see if we can get a breakout back above it with some increasing volume.
All righty. The next one is going to be Broadcom, AVGO.
Okay, I know earlier this one, yeah, I had been surprised earlier that this 255 level didn't hold. You can see the volume. Once it broke down, the stock really struggled. On recent attempts back to the upside, you can see all the failures between 250 and 255. So I think for me, I would set the kind of a resistance zone here at about, I think we can probably maybe even use this gap resistance right here. So I'm going to say 250 to 253 seems to be pretty key resistance that we're going to need to negotiate to the upside and to the downside. Clearly that February low, 224 or so, we're going to watch. We're down at 227 right now. Reward to risk, if you're playing this trading range, isn't too bad here, but I'd be real careful if you lose 224, especially if volume's picking up.
All righty. Next one for you is Weight Watchers, WTW. And no, I'm not hinting at anything.
Probably. Let's see. Weight Watchers is trending higher again, holding the 20-day, and the 20's broken back out above the 50. Volume, though, on this move has been kind of suspect after a pretty heavy selling. So I think it's going to be important to get through that high, and I'd be a seller into it as you get close to that high, just because of the volume trends and so forth. But yeah, I'm going to say 76.5 to half, and you can see that rising 20-day moving average also coming in at that level. So I would highlight that 20-day and that support area. So 67.5 to about 76.5 is the trading range. We're kind of sitting in the middle of it right now. Again, my biggest concern here is that the volume has just been so-so throughout this entire advance, but that's the price resistance and support I'd keep an eye on.
Okay. This one gets requested quite a bit. Let's try Regions Financial, RF.
I like the chart. I like financials. I think interest rates are going to continue to go higher. And this one is in a nice uptrend, followed by sideways consolidation. I do think it's important that it continues to hold this 1775 area down here, because we did make a higher high, print this low, and go up to a new higher high. So you don't want to lose that low, that previous low there. We've gone down. We've tested it. I think we continue to consolidate. Again, I think that Treasury yields are going to go higher in time, and I think these banks are going to continue to perform well. So I'd be a buyer.
All righty. The next one will be, let's see, a biotech, Clearside Biomedical, CLSD. And I know this one was coming up on my scans, I think yesterday.
Yeah, I mean, it's definitely turning back up, and had a huge flagpole flagpole, and maybe maybe a little cup forming after it. But let's annotate here. So I would be looking at this move to the upside, obviously, is a pretty clear uptrend. Maybe we can just start it from over here. But there you've got a nice uptrend in play, and followed by, and this is a long cup that has been forming. But if we go in and we use the parabola, you can mark it from the top there, right down here to this bottom, and we're turning back. So right now you can kind of see this rounded turn. And by the way, at the top of this gap, massive volume, we gapped up. Notice we never went below $10 in here. And if I draw that in, you'll see that has continued to hold. The bottom of this cup came right back down to that $10 level, started to turn back up. Now, it is about 10% above its 20-day moving average, so you got a little risk if you're getting in on the long side. Eventually, my target would be 15 to go up and retest this high. To the downside, the rising 20. That's been holding on this recent move to the upside. So if it pulled back closer, I could get it to 20-day moving average, the better my reward to risk would look.
All right. Next one from Industrials Heavy Construction, Chicago Bridge and Iron, CBI.
Let's see. Well, it looks like maybe the sellers kind of were exhausted. Huge move down in March and early April. Got a little bit of a bounce, and then this exhaustive gap to the downside. Now we're trying to get back through the 50-day moving average. With this move to the downside, I know technically this is not a negative divergence because you need to have a lower closing price. PPOs, MACDs, PMOs, all that. It's based on closing prices, not intraday. So technically, you'd need a lower close, which we don't have because we closed way up here. But I think that the signal there is still pretty significant that the PPO was rising throughout. We went back down, tested the low. I think that's a form of a positive divergence. We're getting to the 50-day moving average, which is where the last rally stopped. And you can see so far that tail above 18, or excuse me, above 16 is a little bit of a problem. So if it were me, I would take the profits if I was in it and see if I could get a close back above 16. I do like the volume that's been coming in, but I would not be surprised to see a pullback maybe one more time to test that rising 20-day moving average. So I would be a little cautious here in the near term.
Okay, let's see. The next one is WPZ, and that is Williams Partners Pipelines.
Okay. Well, one thing to keep in mind is that it's a limited partnership, LP. So if you ever see LP or limited company, something like that, you're going to get a K1. If it's in a taxable account, you're going to have a K1. It just gets confusing from a taxable perspective. I never trade these unless it's in a retirement because of that. But other than that, I mean, technically, I like what's happening here. We've broken back up above the 20, pulled back, tested the 20, and then went through the 50. If we could break through 37, I think that would be making a little bit of a statement here technically. So I'm going to kind of watch 37 there to the upside. In the meantime, to the downside, I like the fact that we're holding the 20-day moving average. I'd like to see that continue, but there is your 20-day test that's so far successful. Beautiful PPO moving back through centerline resistance. If there's one big problem on this chart, it's that the selling has come on much bigger volume than the buying, moving back to the upside. That's why if I see a false breakout or something with a failed, long tail to the top and coming back down and closing below, I'd probably take that as a sell signal.
Okay, let's see. The next one is a little different from what we usually do. MTUM, that is a momentum factor ETF, iShares. USA momentum factor.
All right. I have no idea what that is.
Never seen that one.
I'm going to take a little bit longer chart, though, because I think probably we had a nice uptrend and we're consolidating sideways. Oops, that's not what I wanted to do. So let's see, 10 months. Let's update it. Yeah, really nice uptrend prior, like the overall market. I think we continue to consolidate here. I mean, there's a couple of different patterns you could pick, and it's very volatile from top to bottom. But there is your resistance. Here is your support. I'm going to go down just a little bit further to catch this low over here. But I'm going to say a break below 100 would be bearish. A move back through about 113, 114 would be bullish. I think as we move closer to this 100 level, the more bullish I would be because my reward to risk would be so much more favorable. But overall, we're in the middle of a trading range. It's kind of like the overall market. We're just consolidating. Some think we're in a bear market. Some think we're just correcting. And really, time will tell which one is correct. But either way, you want to try to minimize your risk, whether you're on the long or the short side. And I think the closer you get to this 100 level, 101, the better I would feel about placing a trade. From a longer term perspective, because I'm in the correction camp, I would be using weakness to accumulate.
All righty. And our very last one, SPLK, Splunk.
All right. I love that. The name of the company.
I do too.
I'm not sure. It sounds a little negative, like it's about like Splat. I mean, probably a good thing they didn't come up with the name Splat. But looking at the chart, I tell you what, let's do a relative chart because I haven't done one of these in the segment. And actually, we got a really nice, this software space, which has been doing very well. I think Splunk, you can see, has been doing very well. And as we go down the list, Splunk relative to software has been doing well. Anytime you get in one of the best industry groups and you're one of the better stocks in that industry group, probably not a bad investment. At least as long as it holds on to key price support. And we'll talk about that in just a minute. But here's Splunk relative to the S&P 500 performing well. Here's software literally breaking out to new highs versus the S&P. This is one of the reasons why I have problems believing we're in a bear market. I just don't believe that we've got aggressive companies that are continuing to lead the market as we go into a bear market. But, bear market's set up many different ways, and maybe this will be a different one. But let me annotate this, because from a price perspective, I would be keeping a very close eye on this gap support level around 94. We gapped up. Look at the volume that came in on this move. Got all the way up above 110. Look at that tail, by the way. Probably 112, 113 on that high. Came back down to 109. That marked a pretty significant short-term top. Went all the way back down, essentially filled the gap, moved back up, and now we are consolidating in a range. So I think this is the key area to watch, 94 to 110 on Splunk. We're sitting at 102, literally almost right in the middle of it. I don't see a trade at this point, but I like the company.
All right, and that concludes the 10 and 10. And we should be seeing those symbols right up on the chart there. I will get these up into the Market Watchers live chart list. I showed you how to get to the DecisionPoint live chart list. Works the same way for Market Watchers. Go to the blogs tab, click on the Market Watchers live blog, and the link for the Market Watchers live chart list is right there. And these symbols with the annotations will be up later this evening. Let's see. And with that, let's go ahead and move to a really, really quick discussion about ChartCon. We do have that coming up. It's our every other year conference. Last year we did it streaming live, and we're going to do the same thing. It's reducing risk in uncharted waters, a really great topic from the stockcharts.com/ChartCon page you will get here. One thing I just really wanted to point out today is the fact that we have early bird pricing, and that is going to expire on May 5th. So if you'd like to save $50 on your registration, I suggest you get to it if you haven't already.
The early bird is going to go away in May.
That's right.
I had to use that, go away in May. It's probably one of the most overused phrases this time of the year. I thought I'd try it one more time.
Oh, sure. Why not? You are the seasonality guy after all. So
exactly.
All right. And with that, I think we're going to go ahead and just move right into a market update. And I'm going to do that by going to, there we go. Whoops, wrong one. Just going to go to the member dashboard. I like to go here to the candle glance and take a quick peek. These are 2-day charts. And I'll add the TSX for our Canadian friends. And we will add, let's add the biotechs for today. All right. So as you can see, another down day, unfortunately, for the markets, unless you're a bear, then you're probably excited about another down day. And as you can see, we're just continuing to move lower, making new intraday lows as we speak for the S&P 500, the Dow. NASDAQ is not really doing as badly. We can see that it dropped early in the day, but it's been consolidating just under yesterday's close. So I'd say that doesn't look too... doesn't point to doom and gloom right now in the NASDAQ. Russell 2000, it also started lower, but it has begun to move its way back up during this lunch hour. We can see that the TSX looks very similar to the NASDAQ. We did have a big move down in earlier in the morning, but now we've been trading mostly sideways. You can see that the TNX treasury yields are up right now, reading 2.96%. And we have UUP, large gap up, but we are starting to come back down. Looks like it's at this point using that as gap support at the open. We've also got commodities lower on the day. Big gap down for USO. Looked like it was going to recoup those losses, but it's heading back down, and we're looking for it to probably test more intraday lows. Gold is also lower, big gap down, making an attempt to bring it back, but it's having problems with gap resistance. UUP, gap support, gold, gap resistance. And again, I did point out the correlation right now between Gold and the dollar is very, very strong inverse relationship there. So we should be seeing very similar chart patterns, but in the opposite direction for dollar and gold. And you can see that right here on just the 2-day chart. The VIX is rising, not a surprise, but we are still looking at a reading of 16.79, which is under 17, but we are starting to see a little bit of concern. And biotechs, they've had a really bad slide, but we're now back into the positive. Looks like we might be holding on for XBI at $87 for support today. And I'm going to take you very quickly to the market summary. And we'll just take a look very quickly at which sectors are leading the markets right now. When we're having a big down day where everything is showing a red bar, I usually expect to see consumer staples doing well and materials, but we're not seeing any of those right now. Technology is leading. Utilities is somewhat of a defensive sector, but notice that all of them are down, but the industrial is taking the biggest hit right now. The industrial ETF down 1.84%. As far as industries, the big leader is hardware, and you can see that's up over 1%. With that, I'm going to conclude the final market update, and I'm going to hand it back to you, Tom. You can expand upon this update or go right into our final segment, Under the Radar.
Okay, well, I think we'll just move right on in. I don't really have a whole lot to add. I mean, I do see that there is some nice relative outperformance from the NASDAQ and the Russell 2000 today relative to the Dow and the S&P, especially the Dow, which is being hit hard by Merck and Pfizer and really the pharmas in general. Yeah, I think it's a good segue actually into what I wanted to talk about with the under the radar. So let's take a look at under the radar. Okay, and with that, what I want to do is, should have my chart here. This is the S&P 500. This is an area of support that we want to watch on the S&P in the short term, no doubt about it. Got up, we failed to get through the 50-day and rolling back over, and the recent lows between 26.10 and 26.25 were right there, so it'll be interesting to see. But what I wanted to point out here with under the radar, and I've talked about this a little bit, but honestly, I really haven't seen too many folks on CNBC or Bloomberg really talking about this, but the fact that the dollar has bottomed and is starting to rise so rapidly, I think it does play into performance going forward. And so what I wanted to start with is I wanted to pull up the dollar, and let's just move over to that dollar chart. And I'm going to do a weekly chart, and let's go back 10 years throughout the bull market, because we've had different periods in this bull market where we've seen declining dollar, we've seen huge rallies in the dollar. 2017, we saw a huge decline in the dollar, and that resulted in a lot of outperformance in many of the bigger companies. But I want to focus on a couple of periods where the market, or where the dollar has made big moves to the upside, in particular 2014 into 2015. I went back and I looked, and this is where we were getting a breakout. It looks like we were getting a breakout right about the end of the third quarter of 2014 above that prior high. So from the September 30th, 2014, effectively to the end of the first quarter of 2015, these 6 months right here, I went back and I looked to see how the various indices had performed. The Dow Jones during this period went up 4.3%. The S&P 500 during this period went up 4.9%. The NASDAQ during this 6 months went up 9.1%. And the Russell 2000 during this period went up 13.7%. So it is important to know, or to be, at least aware of what's going on with the dollar, because a lot of times the big moves in the dollar can have major impacts in terms of the rotation between the various indices. Keep in mind that when the dollar's rising, if you have a multinational company and you're doing work overseas, you're doing a lot of business in, say, Europe, in Asia or whatever, and you have to translate those foreign gains back into the U.S. with a rising dollar environment, that eats into your profits. So anytime the dollar starts making a big move higher like this, you have to be aware of it, and the market begins to price that in as well. I think that was shown in the percentages I just gave you. The other time, and I'm just going back the last handful of years, The other time that we had a pretty good move in the dollar was in the second half of 2016. So I went back and looked at the Dow, S&P, NASDAQ, and Russell 2000 for the second half of 2016. The Dow went up 10%, 10.2%. The S&P went up 6.62%. The NASDAQ was up 11.2%, and the Russell 2000, 17.8%. Now, I believe we're just starting to rally in the dollar. So for me, one of the things I think that's very under the radar is the fact that I'm looking for small caps to outperform. And I know you may say, well, recently they haven't been. Well, they're not going to outperform every day. They're not going to outperform every week. But if the dollar continues its move to the upside, I believe we're going to continue to see the Russell 2000 outperform the larger cap companies that do business overseas. Most small cap companies are domestic. And so they're not really impacted by a rising dollar. They're just impacted by what's going on here in the U.S. But the other companies, and I think that's what's going on right now with many of the Dow companies and the S&P, some of the relative weakness that we've been seeing. And I can pull up, we can take a look at the Russell 2000 versus the S&P 500 and put it on a line chart. And since the end of February, the Russell 2000 has been outperforming. This is what I was just talking about. The last week we were lower. Actually, today we're starting to turn back up again. But the overall trend, I think, is pretty clear. It's up. Here we went down for, I don't know, week and a half. Here we've gone down for a week or so. But overall, this trend continues to move higher. And I think as long as the dollar does the same, then I would expect that this is going to continue. We're going to continue to see the small caps outperform. So I think the first under the radar comment that I would have is that I don't think enough traders, enough market participants are focusing on the fact that the dollar hit major support, has turned back up. And I agree with Aaron. I think that level, I'm going to pull up the dollar index here. I think this level up here at around, I'm going to say 82, but 92. I'm going to go out to a weekly chart. I think the weekly chart shows it even better. Because we did have a positive divergence on this lower low here in the dollar. Look at what the PPO had done. We had a higher low. So that tells me we're likely heading for at least a 50 period test. So this strength that we were seeing, which has been straight up on the daily chart, is approaching that 50 period test. You can see the weekly PPO is getting close to centerline resistance. And if you go across here, you'll see multiple lows. I'm going to go back even a few more years here. You're going to see multiple lows around that 92, 93 level. So here, 92 and change, couple here down around 93. After that initial high was set, 92 to 93, 94 was pretty good resistance. Now, as we move back up, there is that falling 50-week moving average that I'm looking for a test of. I think we're going to go through it because of what I've already pointed out about U.S. rates versus Germany. But an initial test of that 50 is what I'd be looking for, simply based on this positive divergence. So, and I think when you were talking about this earlier, Aaron, you pointed out that overhead resistance, and I do agree with you. I think 92 to 92.5, 93 is going to be interesting. And when you look at that 50-week moving average coming in right in there at 92.5, there's a lot of overhead resistance for the dollar. If we break through that, I think we could be on to, I don't know if it'll be this kind of a move, but I do think the dollar is going to show considerable strength. And as I've pointed out during both of these rallies, that tends to really bode well for small cap stocks. So that's at least something to be considering if, in fact, the dollar continues its strength. So that was point number one under the radar. Point number two that I had was that, and I mentioned this in my blog today, I think truckers are at a really interesting level on their chart. They've pulled back. We did have this one move back in early February where we went below 780, but we have not had a daily close below, let's see here. We haven't had a daily close below 785 and change. And right now we're at 787. Now, I like to look at reward to risk when I'm in trading. And I know that when we're in a consolidation phase like we are now, these different groups go into favor and out of favor. I mean, how many times have we gone up and down here on the truckers? Well, we've been going down for the last 2 or 3 weeks, and we are now at a key support level. So I would be looking for truckers perhaps to make a move. I would keep a tight stop, though. because 780 is pretty key support here on the daily chart. And on the weekly chart, there is a negative divergence in play. Or actually, no, there isn't. I think it was a different chart that I was looking at. Maybe it was transports. But anyway, here was the move up. You do have great support here around 775, 780. We are a little bit below that rising 20-day moving average, which is currently at 800. So if we fail to hold on to price support, and let's just call it 775, we close much below 775 area, I think that could be problematic for the truckers. We could see perhaps a 50-week test, and that would probably coincide with this breakout that we saw around 730. So if you lose 775, I'm not interested in holding these stocks for another 40 or 50 points to the downside. So keep that in mind, but we are approaching a key short-term support area. And I thought I would mention a couple of individual truckers that I thought looked a little interesting. One is, I'm going to leave the weekly chart up. This is a small cap, Werner, WERN. And here, this was the one that I was looking at that was the negative divergence. Here you can see the higher price, slightly lower PPO, reversing candle right on the top. And we have been going down now for about 3 months. The stock was up to 44. Now it's down to 34. And it is that, it's just a little below that 50-week moving average and right near this support around 33.50 where it's been holding. So I like the reward to risk here. And again, this is a small cap stock that I'm expecting small caps to outperform. It's also a trucker. Truckers are at support. And so I find a company like this that's been selling off, even though the volume's been heavy, I think you're now at a major support level. And if the truckers bounce and small caps do well, it would seem like Werner could be one that's under the radar. And with that, I'll turn it over to Aaron. What do you have? Do you have anything to add to it, Aaron? I'm not hearing you.
Okay, I'm awake. I'm here. I just wanted to point out, I know a lot of people say as far as under the radar. Let's get back over here. That we should, many people are saying, hey, if you're feeling bearish about the market, why do you keep scanning for buys? And so I wanted to just show very quickly that, as far as under the radar goes, pick those places. I know you were saying that, you're looking for those large cap indexes to not do as well with the rising dollar. And I think you're right on. So I want to scan that. But what I thought I would just show really quickly, I'm not going to go over any symbols. I just wanted to show you why things are looking different here. Let's see. I wanted to take this. And we're going to look at, I don't want the S&P 600. I think I had it already on my dog scan. There we go. So I'm going to take that out. And I'm going to make this the NASDAQ. And we'll add that, save this. I call it scan for dogs. Basically, this is the reverse of this focused PMO scan where I want to go and buy stuff. And so I just wanted to show you the difference here. So if I run this scan to look for a buy, I only get one result. But notice when I scan for dogs, I end up with 9. So I got more, 9 times as many. But one way to go under the radar, I suppose, is if you want to short during a difficult market. Rising dollar maybe means those larger caps aren't going to be doing as well. Maybe look into a sector that you're not feeling comfortable with. But that was all I really wanted to add to the under the radar. Just if you want to go find some under the radar shorts, just reverse any of your buy scans. Just turn those greater than signs to less than signs and go for it.
Yeah, and that was that is an interesting question. We have had survey responses where some of our listeners have asked, why don't we spend more time looking for short candidates? And I can speak for myself that I believe we're still in a bull market. I'm not looking for bearish resolution. I'm still looking for bullish resolution. And I don't like to trade against what my primary trend is. If I think we're in a bull market, I like to be long. If I think we're in a bear market, I like to be short.
That's exactly right.
Well, and for me, it's just I psychologically, it wears on me. If I think we're in a bull market and I try to short the market and then all of a sudden we get an up day, it's really hard for me to take those losses. not that I won't take them, but I don't mean take them from a physical sense of taking the loss in my account. I'm talking about emotionally and mentally taking a loss during a bull market and be shorting during a bull market and end up getting stopped out. It's just something that I would rather not do. So my philosophy is when we are in a market that's downtrending, even though I think it's a bull market, I tend to just trade a lot less, and I'll pile up cash in my account. I just won't trade as much in my account to minimize my risk. That's the way I deal with these periods of consolidation. For 14 or 16 months, we didn't have to deal with any of this. From November 2016 to January of 2018, the markets went straight up. I think it was the longest period in history where the S&P 500 did not have a 3% drop at all. And so the market that we're in right now is completely different than anything that we're used to, or at least, in recent history. And I think that's what's making it very difficult for a lot of traders, because they're still trying to trade the market like it's 2017, and it's not 2017, it's 2018. And a lot of consolidation, a lot more volatility, a lot more impulsive selling, which we saw none of in 2017. And that is what's making the market much more difficult to trade, in my opinion.
Absolutely. And I think you're right. But everybody's thought as to where you are at as far as bull market, bear market, neutral positions. Everybody sort of has their trading time frame and where they see the market during that trading time frame. And that's what you should trade. I mean, that if you're really seeing short-term problems and you really want to get in there and short, be true to your analysis to begin with, though. If you've got to be behind the fact that you're thinking things are bearish and you want to short. I think this example with the scan was excellent in showing that, if you have that really short-term time frame and you're seeing the negative activity, or, for me, I'm getting all these very bad signals, you're going to see more possibilities for shorts than buys. And I think somebody complained on our surveys at one point earlier that they ran a bunch of scans and they just didn't get any results. Well, yeah, I mean, you just saw I got one result from a scan I run all the time, and a lot of times we'll have 20 to 30 come up for a buy. So, I mean, just running that scan tells me there's some serious issues in the market right now.
Yep. All right, well, that's it for the under the radar segment. We hadn't done that for a while, and I thought that there were some good things discussed there, and different ways to trade the market. Certainly, different ways to look at the market. But those were some of the symbols, major indices, ratios, and so forth that I looked at. And Aaron showed you a couple of different scans and how those results came out. Certainly skewed more toward the bearish side for sure, based on the criteria that she likes to use. So we're seeing more trending, I would say, to the downside here in the short term.
Yes.
And with that, I guess we should just get into our schedule for the rest of the week. We got a really big schedule the rest of the week. Got a couple of awesome guests coming in. Why don't you tell everybody about it?
Indeed. And just to let everybody know, the poll right now, over 50% of you think that the market's going to close lower by the end of May. So you're on board with me. That was my.
I didn't vote. I didn't vote there. But when we say the market, are we saying the S&P? Are we saying the
yes.
1000, or what are we saying?
Yes, the S&P 500, the benchmark.
Okay, because I'm going to say the Russell 2000 goes higher. That's mostly what I'm trading, so that's what I'm more concerned with. Although I'm still trading some of the Nasdaq as well. But yeah, some of the larger S&P names and so forth, I'm kind of staying away from. I think some of them came out with great earnings, and there's just no positive response to many of them. I think that's a problem.
Yeah, that's bothersome. That's one of the things I've been thinking about lately as well. Weekly schedule, though, tomorrow we have Tom McClellan. I cannot wait to hear him and his presentation. Bruce Frazier will be here on Thursday, and he is Mr. Wyckoff, so we'll have lots to talk to him about. And then finally, I just heard that our very own Chip Anderson will be here to do the Everything Stock Charts segment on Friday, so you won't want to miss that.
All right, lots coming up. Do want to thank everybody for being with us today. Please remember to complete that survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great afternoon, everybody. App warnings coming up after the bell. See you back here tomorrow. Happy trading.